Hi everyone, this is a short screencast video for F6 taxation for our question 2, Charlie and Susan in the practice and revision kit, page 5. So we know that this is an income tax question which includes a variety of different forms of income, including Schedule E, salary, etc., and also some investment income. Okay, so the first thing that we're going to do in this video is really just look at the requirements. Yeah, that's what we should always do first within an F6 long form question. Let's look at the requirements first. And the reason that we do that is that the requirements are going to give us a fix on what we're looking for when we read down the body of the question. So it's always requirements first to get a good fix on what we're looking at when we read the question. So when we look at part A here, we firstly see that we're required to calculate a taxable lump sum based on this individual's termination of employment, clearly stating the tax treatment of each element of the redundancy package. Now, we should know from our studies that when someone's employment is terminated, they will receive a series of different payments. And that's what your F6 examiner will target. He will give you perhaps 4, maybe 5, or even 6 different types of payment, and he's going to ask you to classify them and then, as we know, apply our exemptions. We have 3 different levels of exemption, and we know that the individual taxpayer can choose the highest. So more of that later when we look at the actual answer. The second part is an income tax computation for 2014 on the basis that the individuals are jointly assessed. So we read into that this couple are married. Joint assessment simply means that we do one income tax computation. The last part, which we're not going to concentrate on too much, is the universal social charge. And just for that, just for the moment, let's just read that there are additional liabilities or additional taxes, let's say, that are payable over and above income tax, and more of that later on in the course. One thing that I'll draw your attention to here is the split of the marks. You'll see that most of the marks are in part B, so that's where we've got to expend most of our time. It would be very easy to get bogged down in this area of the taxable termination payment, and we know that that will impact upon the income tax computation, but you've got to be careful to allocate your time correctly. So basically 1.8 minutes per mark. Okay, so you should within the exam really sort of detail what your end time is on this one, yeah, and also your end time on this one. Yeah, the worst thing that you could do is run over on this area and not get to here. Why? Because there are so many easy marks in an income tax computation, you know, things like tax credits. So speed is very, very important, but also knowing where you are in the question. In other words, you know, you could spend 15 or 20 minutes perhaps trying to get 7 marks and not have enough time to deal with that income tax computation. Okay, so let's go back up to the top of the question. We have a broad fix from just reading the requirements as to what's going to be needed within this narrative. And what we see to start off with, and we knew this already, is that we have 2 individuals who are married. They give us the ages so that we know that they're not plus 65. No sort of issues there in terms of additional allowances for older individuals. They say that they're resident and domiciled. For the moment, let's just take it that everyone that we come into contact with is resident and domiciled. That simply means that they'll be taxed normally, I guess. They have 1 child, age 17. So when I read this, I think to myself, well, the first thing that's of interest is that they're married. So I'm thinking about a tax credit, the married tax credit. That's what that first sort of sentence gives me in the main. Maybe there's something else in relation to the child. Not sure yet because I haven't read down the question further. The next thing that I see is that Susan is going to be made redundant. Okay, when I think about redundancy, I'm thinking about termination. So the next thing I expect to see somewhere in the question is perhaps a series of different payments that she's going to receive, and remember that I need to split them into 3 different groups. Now, the date is the 30th of April 2014. That is significant. More of that later. In other words, she's not being made redundant on the 31st of December. Outside of that, they say that she's been with the company for 21 years and 11 months. Interesting that they give me, a month or a set of months. I'm wondering, why are they doing that? Why are they saying 21 years and 11 months? Again, more of that later. They also tell me for some reason that this particular company didn't have a pension scheme and that she's not provided for a pension privately at all. Okay, now here comes the detail of the payments, in other words, the final payments that she's received, and you'll see that there's 4 in all, 4 payments, and they're all different, 4 different payments, and they're all different. Now, it looks to be that there are some ex gratia payments. There are also some statutory payments, and really we've got to figure out, where do we go with those payments in terms of our 3 groups. I'm hoping that you remember from our studies that we have 3 separate groups, 1 fully exempt, 1 partially exempt, and 1 fully taxable. So we've got to work out of these 4 here, where do each of those payments go. In addition to that, move down the question, we see that they gave us some details on her salary received, including benefits in kind. And they've obviously given us this for a reason, this information here. I'm wondering what that reason is. It's got to be something to do with our 3 exemptions, our 3 exempt amounts, you remember, of which the taxpayer can choose the highest one. They also tell us kindly that the amounts received in the final payment, that are classed as Schedule E, are already included in the salary figure above. In other words, that the redundancy payments, where relevant to Schedule E, are in the figures that we've been given for salaries received in this current year, i.e. up to the 30th of April 2014. Okay, so next sentence here looks at it as if it's relevant to tax credits. We see that Susan had PAYE of £1,500 or €1,500 deducted. That's just a tax credit. If I annotate it there like I've done above, it's easy for me to scan down the question when I get to the tax credits area and pick up each of those easy marks. I really don't want to forget tax credits because they are marks really for very, very little. No high analytical skills required there. It's just really memory, just remembering that we deduct them in the appropriate place. Now they give us some information about Charlie. We see that he earned a salary. So when we see salary, we've got to think again, well, that's definitely a tax credit for him, as with Susan. We also see that his gross salary is 58 with PAYE deducted of 6. That looks to me to be another tax credit, a refundable tax credit. They give us some details on the defined company benefit scheme, in other words, a pension scheme that he is a member of, in other words, an occupational scheme. So in essence, his net relevant earnings are basically just going to be his salary, nothing else. Okay, so we see that he's contributed €15,000. Now we've got to remember that more often than not, the F6 examiner, when he includes pension contributions in a question, he's testing that element of net relevant earnings and whether or not the person has perhaps over contributed. In other words, they've contributed too much based on the relevant earnings that they have. Next issue for Charlie is to do with a benefit in kind. They say that Charlie is provided with a car. Okay, the car was bought new at a cost of 36, but they also give us some details in relation to a market value. They often do that with what we call, car BIKs. This is clearly a benefit in kind. They'll give you two different values. And remember from your car benefit studies, hopefully, that we're interested in the OMV, the original market value. We're not interested in the current market value as provided here. That's just a red herring. In other words, he's included that to see what you do, whether or not you take that figure as being the relevant figure, and hopefully you won't do that. They give us some details on mileage here. Now remember that if we're going to adjust benefit in kind downwards in any way, we're interested in high mileage cars. In other words, cars that have done more than 24,000 kilometers. They say that he's driven a total of 20, but only 20% of that is for business purposes. So we've got to think to ourselves, do we need to adjust the normal percentage, i.e. 30% times OMV? I'm not so sure that we will have, but more of that later. He also pays a contribution. Now just remember, with BIKs, we've got a set sort of 5-step process. A 5-step process. Every time, even if it's a simple one, we see a car benefit calculation required. In other words, John is provided with a car. Let's think about that 5-step process, and that's detailed within your study text, and we've looked at it in a little bit of detail in class. Outside of that, here comes some easy marks here. We've just got some details on some investment income for Charlie, and very, very straightforward stuff. We should remember that, where relevant, investment income is included in the income tax computation gross. So I guess it's just a question of picking up, how do we include these, make sure that they're gross, and also don't forget that these items could have some impact on our tax credits. So it's just a question of us trying to figure out which are the ones that come coupled with a tax credit. We're given a little bit of a hint here. They say net and net. They also say received gross for the UK income. Next bit here, they talk about the a covenant. Now, we've not covered that in class, and I'll explain that when we get to the answer. But essentially, we've got Charlie paying out a covenant, and that's really just a promise. In other words, it's a promise to pay his widowed father, aged 70, basically some income. So that he's paying out 6,000 euros per annum in income. And that is essentially, as you'll see within the deductions chapter, it's just really a simple deduction. A little bit more to it than that, but in essence, what Charlie can do if he's paying a covenant to an individual, and particularly his father, he can deduct the amount as a covenant or as a deduction subject to some conditions. So we'll see more of that in a minute. In addition to that, we've got permanent health insurance here. Permanent health insurance. Now, I'm hoping that we remember from our studies that in relation to permanent health insurance, which is just an individual insuring themselves against being ill in some way down the line and getting some sort of payout when they're ill, is that there are there is a condition attached to the deduction of permanent health insurance within an income tax computation. Just wondering if you can remember that. Okay, so there's the essence of the question. 3 main parts. Watch your presentation, watch your timing, and make sure that you get the question finished one way or another. The pass mark in this, as always, is 50%. It's not 100. Okay, so I'm going to cut it there for the question video. I'll just move on now to the answer video as well. I hope that made sense. Cheers.